Hello friends, welcome to Finance MCQ. I am CA Pritam Sangwan. I hope all of you are doing good. And friends, today we will continue our discussion regarding ratio analysis, which is a part of commerce and accountancy subject of paper 2, which is a technical syllabus of your SEBI exam general stream. Friends, this technical syllabus is of 100 marks in phase 1 and it has 2/3 weightage in phase 2 of your SEBI grade A exam. And friends, you can find entire technical syllabus of SEBI grade A exam chapter wise, topic wise on Finance MCQ website in MCQ question format. You can visit the website and practice entire technical syllabus there. I have put the website link in the description box below. So let's begin. Friends, we have already discussed about meaning and types of ratios in previous video. In that video, we have discussed that ratios are analytical tools used by the management for financial analysis and planning. And friends, we have also seen that there are 4 types of ratios, which are liquidity ratio, leverage ratios, activity ratio, and profitability ratios. And friends, we have already discussed about liquidity ratio in the previous video. If any of you haven't seen that video, I request you to first go and watch that video. And friends, today we will discuss about leverage ratios, that is the second type of ratios. So let's start our discussion on leverage ratios. Friends, leverage ratios are also known as long-term solvency ratios, and this ratio measures long-term stability and structure of the firm. And friends, it indicates the mix of funds provided by the owners and lenders and assures lenders regarding payment of interest and its principal amount. So lenders get an assurance from seeing this leverage ratio whether they will able to recover the principal amount and interest on their borrowed funds. And friends, there are 2 types of leverage ratios. First one is capital structure ratios, and then we have coverage ratios. So in today's video, we will discuss about capital structures ratios. So let's start our discussion on capital structure ratio. Friends, capital structure ratios provide an insight into financing techniques used by a business and also helps to understand long-term solvency positions. Friends, there are various types of capital structure ratios. So let's discuss them in this video. The first type is equity ratio, then we have debt ratio, then debt to equity ratio, then we have debt to total assets ratio, then we have capital gearing ratio, and last we have proprietary ratio. So all these types of ratios are part of a capital structure ratio. So let's start discussing them one by one. Friends, first one is equity ratio. So friends, this ratio indicates proportion of owners' funds to the total funds invested in the business. So this ratio tells how much is the owner's funds out of the total funds which is invested in the business. And friends, the formula to calculate equity ratio is shareholders' equity upon capital employed. Here, shareholders' equity consists of equity share, preference shares, reserves and surplus, and your capital employed consists of your all equity plus all your external borrowings also. So the entire borrowings will part of your this capital employed. So I hope this formula is clear. And friends, higher the owner's equity, lower will be the degree of risk. Why the lower will be the risk? Because the owners has higher equity and the external borrowing is less, hence the risk is less. So I hope this equity ratio is clear. Now let's move on to the next ratio. Now friends, we'll talk about debt ratio. So friends, this ratio is used to analyze long-term solvency of the company, and it indicates total debts of the company, that is how much debt company is having. And friends, this ratio is calculated as total outside liabilities upon total debt plus net worth, or alternatively it can be calculated as total debts upon net assets. So by using either of the formula, we will get debt ratio, and from that we can arrive how much is the total debt of the company. I hope this ratio is clear. Now let's move on to the next ratio. Now friends, let's talk about debt equity ratio. Friends, it is the one of the important ratio that you need to remember for your exam point of view, because out of all this capital structure ratio, this is the most important one. So what is the debt equity ratio? Friends, this ratio indicates proportion of borrowed funds and owners funds. That is how much is the borrowed fund and how much is the owner's fund in the company. And friends, higher the debt equity ratio means less protection to the lenders, and a low debt equity ratio indicates a wider safety cushion. That is, if you are having a high debt equity ratio, it means you have borrowed too much from the market or from the external borrowings, that lenders will feel insecure that whether you will able to repay their loan or not. And if you have a low debt equity ratio, it means you have a high equity and low debt, so the lender will feel safety that you have much higher equity and they don't need to worry about whether you will be in the position to repay their debt or not. Hence it provides a wider cushion if it is have a low debt equity ratio. So I hope this is clear. And friends, this ratio is very often referred in capital structure decision, and it shows firm's financial leverage. And friends, this debt equity ratio is calculated as long-term debts upon shareholders' equity. And what does your long-term debts cover? It covers your all external borrowings, that is your loans, that is your long-term loans, your debentures, bonds, or any other external borrowings that you have taken, and then divided by shareholders equity, which consists of your equity share, preference share capital, and your reserves and surplus. So that will be part of your shareholders equity. So I hope this debt equity ratio is clear to everyone. Let's move on to the next ratio. Now friends, let's talk about other capital structure ratios. The first one is debt to total asset ratio. And friends, this ratio indicates total assets financed with the debt. That is, what is the proportion of your total assets which is financed from your debt capital. So, and the formula is total outside liability upon total assets. And friends, it can also be calculated at total debts upon total assets. Friends, in this ratio, you just need to know the significance of this ratio. You won't be asked to calculate the ratio. They may ask you to calculate debt equity ratio, but all this ratio, you just need to know what this ratio signifies. So just try to remember what this ratio means and what it signifies, rather than mugging up the formula for these ratios. So the next one is capital gearing ratio. This one is also important. Just try to understand the significance of this ratio. Friends, this ratio indicates fixed interest bearing capital to equity shareholders capital. That is, which are the capital that we raised. It may be borrowed capital or owner's capital, which have a fixed interest bearing. That is, on which you have to pay a fixed interest. And friends, the formula is preference shares capital plus debentures plus any other borrowed fund upon equity share capital plus reserves and surplus. So equity share capital and reserves and surplus are shareholders capital, equity shareholders capital, whereas your preference share capital, debentures and other borrowed funds are your fixed interest bearing capital. How come these are the fixed interest bearing capital? Because on preference shares we have to pay a fixed percentage of dividend, and debentures we have to pay a fixed interest rate. Then on other borrowed fund also we need to pay interest. So these are the fixed interest payment capital, whereas equity share capital, reserves are my equity shareholders capital. So just try to remember like that, and the significance of capital gearing ratio. The next one is proprietary ratio. Friends, this ratio indicates the proportion of total assets financed by shareholders. That is, how much assets are financed by the shareholders, and the formula is proprietary funds upon total assets. And friends, your proprietary funds consist of equity share capital, preference share capital, plus reserves and surplus. So this is basically your owner's capital. So proprietary funds upon total assets. So friends, just try to remember the significance of all these three ratios. You won't be asked to calculate the ratio, just they can ask you like what does this proprietary ratio signifies, or they can ask you which ratio helps to identify fixed interest bearing capital to equity share capital. So like that they can ask you. And friends, let's just quickly recap of leverage ratios that so far we have discussed about. That is your equity ratio, debt ratio, debt to equity ratio, then we talk about debt to total asset ratio, then we talk about capital gearing ratio, and then we talk about proprietary ratio. Friends, in this leverage ratio we have just talked about capital structure ratio. So all these ratio pertains to which type of ratio? These are the part of capital structure ratio. And friends, we will keep this video till here only, and in the next video we will talk about coverage ratio, which is another type of leverage ratio. Friends, for more practice of this topic in MCQ format, I request you to please visit Finance MCQ website. It has entire SEBI graded technical syllabus, which is paper 2 of journal stream in MCQ format. It has 2000 plus subject wise, topic wise MCQ questions to practice. We have added explanations for correct answers wherever required. It also has 25 test series for your technical syllabus to practice. So friends, there is lot of study materials to practice on Finance MCQ. Do visit the website for more practice and increase your selection chances. Friends, website link is in the description box below. I will come up with new video. Till then, take care and thank you so much for watching.